Today, the topic is discount rate and expected returns. These two are the most important terms in the financial management. Almost 90% of the topics and problems in this can be solved through these two terms only, can be explained through these terms only. Let's understand these two concepts with an example. Let's say that I gave 1 lakh to you today, and after 1 year, will you give me the same 1 lakh to me? No, because I won't accept it. Because I won't give that money to you for free, right? I will expect something in return. If I gave you that money as loan, then I will expect interest. If I gave you that money as an investment in your business, then I will expect profit. So when I give my money to you and you kept that money for some period of time, then I expect something in return for that period of time. So at the end of the period, you will give me what I expected, I mean, whether interest or profit, in addition to the initial amount I gave to you. So let's say I gave you on loan that 1 lakh, and the interest percentage per annum is 15%. So at the end of the 1 year, you will give me 15,000 interest plus 1 lakh. So total at the end of the period, you will give me 1,15,000. That's expected return. Just because the time has passed a year from now, the value of my 1 lakh rupees today has become 1,15,000. So from this we can say that in any scenario, whether I am giving as a loan or whether I am investing in a business, the value of a rupee today is more than the value of that same rupee in the future, whether it is 1 year or 2 year, 4 years, 5 years, whatever it may be. Every rupee you receive in the future has less value than the rupee you have today, right now, because you can invest that money in something, in anything you want, and get something in return for that investment. So the value of a rupee a year from now is less than the value of rupee today, right now. Now the question is, by how much? To calculate that, we use discount rate. Now discount rate. In the previous example, my expected return was 15% and I gave loan for an interest of 15% and he gave 15% interest to me. I will discuss later in the video how to calculate discount rate. For now, understand that 1,15,000 a year from now, discounted at 15%, will get a present value of 1 lakh. Let's say that I'm an old person and I have earned enough money at my retirement to enjoy the rest of my life without earning anything. No, I will not be expecting anything. I will not be interested in investing in anything. I will not be interested in economic part of my life. So now, in my old age, if I have saved enough money to live out the rest of my life, then I won't be expecting anything. Then will the discount rate be zero? No, because today I have 1 lakh rupee and I can buy some things with that 1 lakh. A year from now, with the same 1 lakh, I cannot buy the same things. Whatever I bought today, I will not be able to buy the same things after 1 year because of inflation. Now, because of inflation, the value of my rupee will decrease after a period of time. Right now, the inflation of in India is around 6 to 7%. To avoid losing the purchasing power of my rupee, I will do a fixed deposit in a bank. And the bank fixed deposit interest rate is also 7%. And because I deposited my amount in a bank, the bank gives me the same percentage as inflation in return for me. So whatever is decreased, whatever the value is decreased by the inflation will be covered by the bank. So I will have the same purchasing power as I had 1 year ago. If I'm starting a business and let's say I'm investing a 3 lakhs amount, I might expect a return of 200%. And also there may be another businessman who is in the same business for almost 10 years, and his expected rate of return may be different from mine. He may be expecting some 20 to 30%, but I'm expecting 100 to 200%. So expected rate of return will be different for each and every person depending on their preferences. Some may be expecting 30%, some may be expecting, like I said, 8%, some may be expecting 200, 300, 400, whatever it may be. While setting his expectations, what are the factors he will consider? Okay, every person will consider at least one or two factors while setting his expectations. Generally, these are the factors that every person will consider while setting his expectation of his returns. One is inflation, two is risk of the project or investment, three, the time period of the investment, four, the industry in which he is going to invest, opportunity cost, government policies, political environment of the country. Now, let's understand these factors with an example. Let's say that I want to invest my money in developing a software that is image and video processing with AI integration along with video editing, shortcut EYV. Now, when I'm investing in this business, I will be expecting more than what I invested in the future. Now, the question is, by how much? By how much? That is my expected rate of return. How do we set that expected rate of return? Let's see. Because of inflation, the purchasing power of my money today will be decreased in the future. So to cover that purchasing power, I need to get a minimum of 7%. Minimum expected rate of return for this project will be 7% to account for inflation. Now, the second factor while setting my expectation in returns is risk of the project or investment. What we need to understand here is that when the risk of the project is increasing, my expectation in returns should also increase. Now, my project is in software development. Every software will be obsolete after 1 year because of how the environment is right now. Whatever software we were using 3 years before is not in existence right now. So the biggest risk in the software development is obsolescence. So to cover that risk, I will set an expectation of 25%. Now let's understand the factors, the time period of the investment and also opportunity cost. Let's say that this software development, it takes a minimum of 2 years. So my investment is locked in that project for a minimum of 2 years. So in the whole of 2 years, I will not be able to use that amount to invest in any other project. So my opportunities is lost because I invested in here. If I hadn't invested in this project, I might be able to give that amount for a loan. I might be able to invest in another business. So to cover that opportunity cost for this amount of time, for this time period, I will add another 15% as my expected rate of return to the expected rate of return. Now the total expected rate of return is 7% for inflation to cover the purchasing power of my money, and 25% for the risk I am taking to invest in this project, and another 15% to cover the time period and also the opportunity cost of this project, because I will not be able to invest that amount in any other project, right? So for this 15%. Now the next factor to consider while setting my expected rate of return is the industry in which my project is in. Now the industry is here IT industry. In IT industry, there is a lot of competition, and also it keeps on updating almost on a daily basis. So it has high risk of being obsolete and also overwhelmed by the competition. So to cover these two aspects, I need additional 15%. Additional 15% of the return. So my total expected rate of return will be now 7% to cover inflation, and 25% for the risk I am taking, 15% for the term of the project and also the opportunity cost I am losing, and 15% for the industry I am in. Now, the next factor to consider while setting the expected rate of return is government policies. Now, what are the government policies? Whether it is tax rates or subsidies or some other benefits or barriers the government may impose. Let's say that the industry I'm investing in has high rates of taxes. If there are high rates of taxes, then whatever the return I may be getting in the future may be reduced because of the high rates of taxes, because I will be paying the amount to government. No? So to cover that high rates of taxes, I have to increase my rate of return, expected rate of return. Or the government may provide subsidy to encourage businesses to enter that industry. So when I'm taking subsidy from the government, then my cost will be reduced and also I'm getting something in return from the government. So I will not be required to expect more money in the future. So my expected rate of return will also be reduced because of that subsidy. In this example, let's say that because of the government policies, plus or minus 8%. So my total expected rate of return now will be 7%, 25%, 15%, 15%, plus or minus 8% for government policies. So the total rate of return will be either 70% or 54%, whatever it may be. Now we'll take an average between those two. Let's say 60% expected rate of return. Let's keep this aside and I will tell you one scenario, one factor which is only considered in extreme scenarios. The last factor was political environment of the country. Let's say that my country has declared a war on some other country. Now, in war times, generally the prices will be higher. Prices will increase rapidly. So, my rupee value will be decreased drastically. So to cover that drastic decrease in my value of the rupee, I have to expect very high rate of return. In those extreme cases, my expected rate of return will also be extremely high. If you want to start a business in those kind of economies, you have to consider the political stability of the country also. If the political stability is not good, then in future the value of that rupee you are holding will be drastically decreased. So you have to account for that extremities also. To cover that extremities, you may need to increase your expected rate of return based on the degree of political imbalances. Okay, keep that in mind whenever you are trying to decide in those circumstances. But in this example, the total expected rate of return is 60%. Now, what this 60% means is that I will be expecting a return of 60% per year on the amount I invested in the project. Let's say, for example, I have invested 5,000 in the project. So, every year I will be expecting a return of 60% on the investment. So, let's say the project ends at the end of first year. Based on my expected rate of return, what I should get after 1 year? 5,000, whatever I invested, plus 60%. 5,000 into 60%. So the total amount I should receive is 5,000 plus 3,000 is equal to 8,000. If the project is closed after 1 year, then I should get 8,000. So if you observe this formula, how did we arrive at 8,000? 5,000 plus 5,000 plus 60% is equal to 8,000. Now let's understand these terms properly. Now what does 5,000 represent? 5,000 represents the 100% of the investment I have made in this project. 100% of the investment. Okay. So 5,000 can also be written as 5,000 into 100%. and also the second term. Second term is 5000 into 60%. Here, what does this term represent? This term represents that I have invested 5000 and on that 5000 I am expecting a 60% return. So this whole thing will be 5000 into 60 divided by 100. It can also be written as 5000 into 60% is equal to 8000. In these two terms, the common factor, the maximum common factor is 5000, because 5000 into 100% plus 5000 into 60% is equal to 8000. So if we take out the common factor in these two terms, that is 5000, in the bracket we will get 100% plus 60%. 5000 into 100% plus 50% plus 60% is equal to 8000. Now 100% can also be written as 100 divided by 100. 60% can be written as 60 divided by 100. 100 divided by 100 will be 1. 60 divided by 100 will be 0.6. So 5000 into 1 plus 0.6 is equal to 8000. This can also be written as 5000 into 1.6 is equal to 8000. We arrived at an equation here. What is this equation? See, 5000 represents the investment I made at the start of the project. Let's say I'm starting the project today, then 5000 represents the present value of the money. Present value. 5000 represents present value. And 1 plus 0.6. The second term in the equation is 1 plus 0.6. Now here 1 represents the 100% of the investment and 60 represents the expected rate of return of the investment. So the 60 can be termed as R. Okay, 5000 will be termed as present value, say PV, and 1 will be 1 because whatever the investment may be, whether it is 5000 or whether it is 1 lakh or 100 crores also, 100% of 100 crores is also 100 crores. So 1 will not change, but expected rate of return will change, because expected rate of return will vary depending upon the person's choices and his preferences. In the same way, my present value, my investment will be different. See, here my investment is 5000. Maybe I'm investing 3 lakhs in this project. If I'm investing 3 lakhs in this project, PV will be represented as 3 lakhs. And also, in this project, my expected rate of return is 60%. Maybe I might expect 25% also. Then R will be 25%. So 3 lakhs into 1.25 is equal to 3,75,000. So what does this 3,75,000 represent? The future value return I am going to get in the future. So my equation will be present value into 1 plus R is equal to future value. In this equation, if you know any two variables, you can easily find out the other variable by substituting the values. Let's say you know future value and present value. You want to find out expected rate of return. What will you do? The future value is, let's say, 1 lakh rupees, and the present value is, let's say, 60,000 rupees. 1 plus R. 1 plus R. I don't know what is R. So here 60,000 is in multiplication. So when I send this 60,000 to this side, then it will become 1 plus R is equal to 1 lakh divided by 60,000. Then it will be 1.66. So 1 plus R is equal to 1.66. We have to find out R, right? So keep this R in this side and send that 1 to the right hand side of the equation. Then 1.67 minus 1. So R will be 0.67 or 67%. Now whenever we know any two of the variables in here, we can find out the other variable. Now this equation is to calculate future value for 1 year. Let's continue the previous example here. In the previous example, 8,000 is the future value of first year. Now when we start the second year, when I'm starting a second year, at that point of time I will have 8,000, because after 1 year I received 8,000, right? Now I will be having at the start of the second year 8,000 to invest in the project. Now when I am investing 8,000 and I will be expecting 60% return on that 8,000 in the second year. In the first year my initial investment is 5,000. At the end of the first year I received additional 3,000 and my investment at the second year is 8,000. Now on this 8,000 I will again, in the second year also, I will again expect a return of 60%. Now here for second year the equation will be 8,000 plus 8,000 into 60%. Okay. Now here we can also write 8,000 as 5,000 into 1 plus 0.6. If you remember the previous example, in the previous thing, 5,000 into 1 plus 0.6 is equal to 8,000, right? So from there, we can derive that 8,000 can also be written as 5,000 into 1 plus 0.6. Plus, in the second term also, 8,000 can be written as 5,000 into 1 plus 0.6 into 60%. In this expression also, we have a common factor. In these two terms, the common factor is 5,000 into 1 plus 0.6. If we remove the common factor, then the remaining values will be 1 plus here 0.6. I mean 60%. 60% can also be written as 0.6. So 5,000 into 1 plus 0.6 into 1 plus 0.6. So 1 plus 0.6 into 1 plus 0.6 can be written as 1 plus 0.6 square. Now when I am calculating future value for 1 year, then the power will be 1. For what? 1 plus 0.6, 1 plus r, whatever it may be. For that expression, power will be 1. But when I am calculating it for the second year, power will be 2. In the same way, if we repeat the same activity for the next third year and fourth year and so on, we will get expression as 5,000 into 1 plus 0.6 2 for power 2 for second year, and power 3 for third year, and power 4 for fourth year. The same way it goes on until n, for any n number of years, from 1 to any number. Future value can be represented as present value into 1 plus expected rate of return power n. N can be anything from 1 to infinity, is equal to future value. Expected rate of return and discount rate, they are both the same. The difference is that when we are trying to find out future value by multiplying present value into 1 plus r, then that r will be known as expected rate of return. And when we are trying to find the present value by dividing future value divided by 1 plus r power n, then here that r will be my discount rate. They both represent the same thing, but in different context, their name will be different. That's it. Other than that, everything is same about them. Okay.